Hi and welcome to Westpac London's end of day report for Wednesday, October the 5th. October the 6th is my parents' wedding anniversary. Happy wedding anniversary, Mum and Dad. 49 great years. That's for the 6th. On the 5th, economic data probably took a bit of a second tier sort of status. I'll run through the main numbers, but then get to what's really been driving the very positive sentiment on equity markets today. We had a downward revision to the services PMI for Europe in September, implying an even steeper degree of contraction in that part of the European economy. Another indicator that Europe is probably either in or slipping towards recession, our view being that we'll certainly see a recession in Europe in the first half of next year, possibly even starting at the end of this year. We had a downward revision to UK GDP growth, economic growth in the second quarter from 0.2% to just 0.1%. Also a downward revision to the first quarter number. So basically, the UK economy has now been stalled since about October of last year. So the underlying weakness in the UK economy that we've been talking about for some time was emphasised by those numbers today. Our view is that the Bank of England will probably embark on a further round of asset purchases or quantitative easing, probably announce it in November of this year. In the US, we had some pretty decent numbers actually, a stronger than expected private sector payrolls report from ADP for the month of September. It rose 91,000. That comes ahead of the official payrolls data on Friday. The relationship between the two isn't that good. The ADP numbers often overstate or understate quite substantially the outcome in the first print of the official employment numbers. I mean, we're still sticking with our weak forecast of a 30,000 rise in payrolls, September, due out on Friday, 60,000 private, 30,000 total because of the ongoing loss of jobs in the public sector. Also on the labour market in the US, we had a 212% rise over the year in September in corporate layoff announcements, although most of those were in the Army, which announced a 5-year troop reduction plan. Also Bank of America layoffs, which were quite significant, they were captured in that report too. I mean, the number is very high. I mean, some of it can be explained, but there is also evidence there of a deteriorating trend in terms of firms announcing layoffs. So that's a bit of a contrast to that stronger private payrolls number I mentioned. We had the services sector PMI or ISM for the US as well. It was a little bit stronger than we expected, but still weaker than in the previous month. It went from 53.3 down to 53.0. It's kind of been hovering around that 53 area for the last 4 months or so. Way down on the sort of 60 level it peaked at earlier this year, but not continuing to dip, which is pretty impressive given some of the bad news that's been thrown at the economy, given the weaker employment story we've seen on some indicators, given weak household income growth, all of which tends to impact on consumer spending on discretionaries, which includes services. So the services ISM has held up reasonably well. It's certainly soft, but it's another indicator that suggests the US economy isn't in recession quite yet. Certainly the sense that the US economy has lost a lot of momentum is still validated by that report. It's just that it wasn't as weak as it could have been. That's it in terms of the numbers today. What really drove equity markets higher, particularly in Europe though, is this ongoing speculation that something is afoot, that something's been planned by European policymakers. I mean, we've had IMF comments about the need for a bank recapitalisation plan to be put in place in Europe. Other officials have been making comments that everyone knows that this is actually going on along those lines, but nothing's really formally been announced. Nevertheless, banking sector stocks performed very well today and contributed to some very decent gains on European markets. It's only 20 past 4 in London at the moment, so European markets are still trading. But as I speak, we've got the German market up 5% today, the FTSE in London is up 3.4%, and the French market up 4.1% as well. So whereas yesterday it was all about concern about the banks being exposed to the sovereign debt issue in Europe, and that was marking markets down sharply. Today there's this sense that some sort of response is going to be coming through, and it's going to be a substantial one. At least that's what investors are thinking today. European markets also benefited from the late rally on Wall Street yesterday, and I suppose a little bit too from that reasonably positive US economic data that we saw. However, US markets themselves haven't put on as impressive gains. We're looking at just a 0.4% rise in the Dow at the moment. It's at 10,849, and the broader S&P measures up about 0.6%. The Nasdaq's up just over 1%. Commodity prices, they're doing okay today. Crude oil, in fact, is up almost 4%. We're looking at $78.60 a barrel, and quite a few other positives, but mainly in the soft commodities. Gold's actually flat on the day, $1,614 an ounce, and copper prices are down 1.6% at 305 cents a pound. The Aussie dollar's doing okay though. It's at 96 cents exactly as I speak. It's been rising in line with the positive equity market sentiment today. That's about it. I'll be back tomorrow, and then of course on Friday is the big day when we get the US jobs numbers. Tomorrow is an important day because of the interest rate decisions that we're going to get from the European Central Bank and the Bank of England. We're not expecting any change in either policy rate at this stage. We're certainly looking for the ECB to cut rates before the end of this year. And as I said earlier, the Bank of England will probably embark on QE further QE before the end of this year. But we're not expecting any announcement tomorrow. One thing to note too, European Central Bank President Trichet, it's his last meeting as the ECB chief. Mario Draghi takes over for the November meeting, and that could be the one really to watch. Okay, back soon. Well, and tomorrow.